and welcome to Value Alchemy Lab. Future masters of investing, have you ever faced this dilemma? When looking at the stock market, some companies have price-to-earnings ratios so high that they seem to shout, "I'm too expensive, stay away." Meanwhile, others have extremely low PE ratios, almost like they're on clearance sale, tempting us to scoop them up. Yet history often reveals a cruel truth. Many of the stocks we once thought were too expensive eventually become 10-baggers or even 100-baggers, while those that appeared cheap sometimes trap investors in years of disappointment and losses. Why does this happen? Could it be that our common sense approach to valuation is missing something important? Today, we'll explore the investment philosophy of one of Wall Street's greatest legends, Peter Lynch, and uncover the logic behind the indicator he famously championed, the PEG ratio. During his 13 years managing Fidelity's Magellan Fund from 1977 to 1990, Lynch achieved an extraordinary average annual return of about 29.2%, growing the fund from roughly $18 million to $14 billion. In doing so, he became one of the most successful fund managers in history. But Lynch wasn't simply hunting for cheap stocks. Instead, he excelled at identifying growth companies that the market had underestimated. Lynch once said, "Invest in what you know." But understanding a business alone isn't always enough. Investors also need a practical way to judge whether a company with great potential is reasonably priced. That's where the concept we're discussing today comes in. The PEG ratio, short for price to earnings to growth. You might ask, if we already use the PE ratio to judge whether a stock is expensive or cheap, why add a G, growth, into the equation? This was Lynch's key insight. He understood that while today's price matters, a company's future growth potential is what ultimately determines its long-term value. Ignoring growth is like judging a tree only by its height today, without considering how fast it grows each year. It gives you only a partial picture. In this episode, we'll break down what the PEG ratio is, how it's calculated, and how investors interpret it. We'll also look at real examples, including companies like Home Depot and Walmart, to see why a stock with a seemingly high PE ratio might actually be undervalued when viewed through the lens of growth. Now let's begin this journey into the wisdom of investing. Let's begin with the definition of the PEG ratio. PEG stands for the price to earnings to growth ratio. The formula is straightforward. PEG equals PE ratio divided by expected earnings growth rate. The PE ratio, price divided by earnings per share, tells us how much investors are willing to pay for each dollar of a company's earnings. The earnings growth rate, on the other hand, represents the company's expected annual growth in profits over the coming years, usually expressed as a percentage. When calculating PEG, the growth rate is typically used as its numerical percentage value. For example, if the expected growth rate is 20%, we use the number 20 in the formula, not 0.2. So how should investors interpret this number? Peter Lynch suggested that when a company's PEG ratio is around 1 or lower, the stock may be reasonably valued or even undervalued relative to its growth potential. In simple terms, if a company's PE ratio roughly matches its earnings growth rate, the price may be justified by the company's future expansion. But context matters. Lynch never treated PEG as a rigid formula or a magic number. In fact, Peter Lynch didn't treat the PEG ratio as a strict mathematical rule at all. To him, it was more like a quick valuation intuition, a simple mental shortcut that helps investors judge whether a company's price and growth are roughly in balance. In other words, PEG was never meant to replace real research. Instead, it helps investors quickly spot situations where growth might justify what appears to be a high valuation. It's a starting point, a screening tool, not a substitute for deeper research. That means investors should still examine where the growth is coming from. Is it sustainable? Does the company have a durable competitive advantage? Is the management team capable of executing its strategy? As Lynch famously warned, if you can't explain how a company makes money, you shouldn't invest in it. Imagine you're shopping for a car. One option is a high-performance Ferrari, expensive, yes, but offering incredible speed, precision engineering, and brand prestige. The other option is an ordinary sedan, much cheaper, but with average performance. If we think of the PEG ratio as a kind of value for performance, the Ferrari's higher price might actually make sense because its performance is dramatically better. Over time, the experience and capability it delivers may far exceed what the cheaper car provides. Investing in high-growth companies can work in a similar way. The initial price may be higher, but the long-term value they create can more than justify the cost. Now let's explore a key question. Why did Peter Lynch often argue that stocks with high PE ratios might actually be better investments than those that appear cheap? The answer lies in growth. Traditional value investing often emphasizes low PE ratios as a sign of undervaluation. But Lynch recognized that a low PE can sometimes hide what he called a value trap. Imagine a company in a mature industry, perhaps an old steel manufacturer or a traditional automaker. Its PE ratio might be only 5 or 8, which looks incredibly cheap at first glance. But when you examine the business more closely, you might discover that its profits have stagnated for years. The industry may be shrinking, innovation is limited, and future growth prospects are weak. In that case, the company's expected earnings growth rate might be close to 0 or even negative. If growth disappears, the PEG ratio becomes meaningless. A low PE alone cannot create future returns. In Lynch's words, buying a no-growth company simply because it looks cheap is like buying a luxury car that has no engine. No matter how attractive the price is, it still won't take you anywhere. By contrast, companies with high PE ratios often look expensive because the market expects strong growth. Many of these firms operate in expanding industries, possess innovative business models, or have visionary leadership teams. If a company's earnings are growing at 20%, 30%, or even faster, a seemingly high PE ratio may actually be justified. When growth is strong enough, the PEG ratio can still remain around, or even below 1. This is the heart of Lynch's philosophy. He wasn't simply searching for low prices. He was searching for growth that the market hadn't fully recognized yet. As Lynch once observed, over the long run, a stock's return tends to follow the growth of the company's earnings. Theory is helpful, but real-world examples make the lesson clearer. During his time managing the Magellan Fund, Peter Lynch repeatedly demonstrated how this growth-focused mindset could identify extraordinary companies. Let's look at two famous cases. In the early 1980s, Home Depot was still a relatively young company. To many traditional investors, it looked like an expensive new retailer with a higher-than-average PE ratio. But Peter Lynch saw something different. He saw a revolutionary warehouse-style retail model, massive store layouts, an enormous variety of home improvement products, and a perfect alignment with the growing DIY culture in the United States. These factors created explosive store expansion and rapid profit growth. Home Depot's earnings growth rate was so strong that even with a relatively high PE ratio, its PEG ratio remained attractive. Lynch recognized that the market had not yet fully priced in the company's long-term potential. Over time, Home Depot became one of the great success stories of American retail and a powerful example of how identifying growth early can lead to extraordinary returns. Walmart is another classic example that Lynch frequently discussed. Interestingly, Lynch later admitted that in Walmart's early years, he initially hesitated because its PE ratio seemed high compared with traditional retailers. As a result, he missed part of its most dramatic early rise. At the time, Walmart's valuation did appear rich relative to slower-growing competitors. But Lynch later realized that he had underestimated the company's extraordinary growth potential. With an efficient supply chain, strong bargaining power with suppliers, a rural-first expansion strategy, and the visionary leadership of its founder Sam Walton, Walmart was able to offer lower prices while steadily gaining market share. This relentless expansion translated into rapid earnings growth. In hindsight, what once appeared to be an expensive valuation was actually quite reasonable given the company's long-term trajectory. Lynch later acknowledged that rejecting a great growth company simply because its P/E ratio looks high can mean missing the most important investment opportunities. These examples illustrate the true value of the PEG perspective. It helps investors move beyond the surface appearance of P/E ratios and focus instead on the deeper driver of long-term returns: sustainable growth. Through today's discussion, we've explored the ideas of Peter Lynch and the concept he popularized, the PEG ratio. Behind this simple formula lies a powerful investment insight. Price must always be considered together with growth. The PEG ratio reminds us not to be misled by a stock's appearance of being cheap or expensive. A company with a high P/E ratio may still be undervalued if its earnings are growing rapidly. Conversely, a low P/E ratio may hide a value trap if the business has little or no growth ahead. For Lynch, investing was never just about numbers, it was about understanding businesses. He encouraged investors to study companies with the curiosity of an archaeologist, experience products like a consumer, and think about business models like an entrepreneur. Because true wealth is often created by companies with powerful growth stories, companies that the market may temporarily overlook. So the next time you see a stock with a high P/E ratio, don't rush to dismiss it. Pause and ask a few deeper questions. How fast is the company growing? What is its PEG ratio? And does its growth story truly make sense? Remember, investing is more like constructing a lasting building than lighting a brief firework. Real wealth is built patiently through research, discipline, and a focus on long-term growth. May Peter Lynch's insights into the PEG ratio serve as a guiding light on your own investment journey, helping you discover the growth opportunities that others may overlook. Thank you for watching. If this perspective resonated with you, consider subscribing for more explorations into timeless investment thinking.